You're welcome back. As we begin from this point, we have started going deep into crypto trading. Let me remind you of what we're required to do. I said watch as many times as possible. If you don't understand any part of the video, watch it 2 or 3 times so that you'll be able to understand before you move to the next course or next video. Try and understand what we mean before you move to the next video. What is technical analysis? Now, technical analysis, called TA for short, is a subjective study that combines statistics with patterns that must be recognized by the naked eye. TA is the study of price action, chart patterns, trends, volumes, indicators, and trades. Traders can use them to predict future market outcomes or price movement with some degree of accuracy. Technical analysis helps you to know what is happening, what has happened in the market, and then give you information on how to know what is going to happen next in the market. So you use previous information to determine what is going to happen in the future in the market. So as we start in the beginning of the course, we said that you can buy into the market because you're expecting that the price of the commodity or the price of the asset is going to go up, or short the market if you expect that the price of that asset is going to go down. So with previous information from the market, from the chart, you can be able to determine with some degree of accuracy where the market is heading next. So TA gives you that information. So you use chart patterns, you trend volumes, indicators, and other things to determine what will happen in the market. Now, for you to understand TA, you need to understand the Japanese candlestick. So candlesticks are formed using the open, high, low, and close of a chosen time frame. We have 2 candlesticks. We have the bullish candlestick and then we have the bearish candlesticks. So this is the bullish candlesticks, mostly represented in green. So we have also the bearish candle, mostly represented in red. So what is the difference between these 2 candlesticks? Now, we said the candlesticks is formed using the open, we have the high, we have the low, and then we have the close. Now, what differentiates between these 2 candlesticks, the bearish and the bullish candlesticks, is this: all these 2, they both have the open, they both have the close, they both have low, both have the high, both of them have the high. So what is the major difference? Now, if you notice on the bullish candle, the open is below here, while on the bearish, the open is high. This is where the open is. That is like opposite, right? So this is it, right? This is what it means. So a bullish candle is a candle that opens below and closes above. So it simply means that within this period, the market went up because it opened here and then closed above. That is a bullish candle. So any candle that opens below and then closes above is a bullish candle, even if it's represented with white or green, right? So even though the candle came to this position, but still it went up and then closed here. Even though the candle came as high as this, but it closes below the high. So any bullish candle opens here or opens below and then closes above. Reverse the case with the bearish candle. The bearish candle opens above and then closes below. Simply mean that within this period the market went down. So because it opens below and then closes above. So most bearish candles are presented with red, maybe sometimes with black. So for the purpose of this class, we're going to be using green and then red. Green to show or represent a bullish candle, while the red represents a bearish candlestick. This is a typical example of the bullish and a bearish candle. As you can see, they both have the high, they have close, they have open. This one also, they have both have open, they both have low. The major difference is where they open and where they close. That's different, only difference. The bullish candle opens below and closes above, while the bearish candle opens above and then closes below. Now, because you also have your app, your Binance app, when you open your Binance app, check for any trading pair, and then you can see the bullish and the bearish candles. So these are candlesticks. You can see some of them are red, some of them are green. No matter how tall or long or big a candle is, if it is red, it is a bearish candle. If it is green, it is a bullish candle. So if you can see here, this is a very big bullish candle, very big red candle here. We have some small red candles. They are all bearish candle. Bearish candle meaning price went down in that period, while in a green candle, prices went up within that period. Right? We have different periods. As we said previously, you choose your time frame. Time frame meaning candles have times that they are formed: 1 minute, 2 minutes, 1 hour, 30 minutes, 15 minutes, 2 hours, weekly time frames. We have daily, we have monthly time frames. So within period, we have candles are formed. Formation of the candlesticks, the psychology. What is the psychology of the formation of the candlesticks? Now, from the previous slide, you see different sizes of a candlestick. We have different sizes of a candlestick. Some are very big, some are small. So in the next class, what we are trying to understand is what is the psychology of the formation of the candlesticks. If you see a candle, what does it signify? What is it telling you? And then what are you going to use the information for? As I said, TA helps you to gives you information about the market, and then you use that information to predict or know what is going to happen next in the market. So candlesticks give you that information. When you see a candle, you know what actually happened within that period. So formation of a candlestick, the psychology. Now this is it. These candles, we call them the hammer candles. Now you can see it has a small body. This is a body of a candle, and this, we call it the tail. This is a tail. We have a long tail here, and then we have a very short tail below it here, and then this green part is the body. Right, this is the body, this is the tail. We have a small tail below here. So what is the psychology of this? Now, what this means is this: when you see a candle like this, it simply means that we have, I said, all candles have open and then all have a close. They have a high and they have their low. All candles have that, as we explained previously. So this candle also has the high, also has the low, it also has the open, and then it has the close. So this is the highest, this is the high of the candle. So what this means is this candle went up as high as this, but came back and closed below here. This is the close, and then the beginning here is the open, and then the small wick here, the small tail here, is the low. The psychology is this: prices open here but went up to that position, this high, but came back down and then closed here. So this is the psychology. So within that period, you should know that even though the prices open here and then went up to that this position but closes below the high, it simply means within that period there are a lot of sellers here. This is why we have this long tail. There are a lot of sellers within this period. Most of the time, prices will be coming from here. Maybe prices are going up from here. They're going up, they're going up. When they reach this position, sellers step into the market and then sold the market and they make the market to come and close here. That's the psychology of the formation of this particular candle. Call it the hammer candle. So if the market is going up, and then most of the time when you see a hammer candle, it's signifying that the market, there are a lot of sellers within this range, and then they are telling you that they are willing to push the market down. That is the psychology of this particular hammer candle. So the opposite is true with this other one. This other candle is also a hammer candle. What it signifies is this: it also has the low, it's low. It also have the close, and then it also has the open, and then it has high. Right? What it means is this: maybe the market has been coming down, and then when they reach this position, buyers step into the market, moving the price up and then closing here. Even though the price closed above the low, this is the low, the price closed below, there are a lot of sellers here. Another thing about this psychology is this: the color of the candle here doesn't matter. It can be red or green. What it means is this: you just need to understand what it means. It means that there are a lot of sellers here in the market. They are the ones that push the market and made it close with the small body. That is the only thing. So even this one can be, even this can be, this one can be red. The psychology is the most important thing, because it's showing you that sellers step into the market, pushing the markets down. So you should, from this point, you should expect that the market is trying to tell you that prices can begin to go down from this position. Even though you don't only use the pin bar or the hammer candle to take your trading decision, you have other things that you need to check before you take your trading decision. But psychology is very important, that you know that. And when you see the candle like this, the psychology is what I'm trying to explain. right? So when you see candles like this ones here, you can see some hammer candles, some small candles. You should just know the psychology. When you see a candle with long tail like this, you should just know that prices came as low as this, but buyers step into the market and close the market above it. So as you can see, this they are both, see, the one is red and then the other is green. It's just showing you that buyers step into the market, while here this red with this long tail showing you that sellers step into the market to push the market down. So the psychology is very important, that you know when you see a candle, you should just be able to know what really happened within that period, right? So the previous one, I explained what the pin bar is, or the hammer candle. We call it pin bar, pin, or the hammer. It's very important in trading that you know the pin bar and then you know the psychology behind it. The next one I want to explain is the engulfing bar. So the bullish and the bearish engulfing bar. The bullish engulfing bar, you have a small red candle and then a very big green candle that engulf the red candle completely. Most of the time when you see a bullish engulfing bar, it's trying to tell you that from this position, that the price of the market, or the price in the market, can go up from there. So when you see a bullish, most of the time the prices will be going down, and then you see a bullish engulfing bar signifying the prices are going to go up from that position. Just a bullish engulfing bar. So it's very important that you understand the psychology behind the formation of the bullish engulfing bar. Bullish engulfing bar meaning that sellers are getting tired or weared out in the market, and then buyers are beginning to step into the market. That's the bullish engulfing bar. Reverse, or the other way, is the bearish engulfing bar, meaning buyers are becoming weak in the market and sellers are stepping into the market. That is the bearish engulfing pattern. So a bearish engulfing pattern appears when the prices of market are going up. You see a bearish engulfing bar, it's telling you that chances are prices are going to go down from that position, from that point in the market. As I said, when you see a bearish engulfing bar or a pin bar, you don't just jump into the market because you're seeing a bearish engulfing bar or a pin bar expecting that the price or the market is going to reverse from that point. The reason why we're explaining this is this: for you to understand the psychology behind it. There are other things here you need to put together to be able to take decisions, so that you'll be able to reduce the chances or increase your probability of winning a trade. So you don't just rush into the market, take a decision because you have seen a bearish or a bullish engulfing bar or a pin bar. Just take your decision that you expect that the market is going to go up. So as you continue the course, you begin to understand other things that you need to put into consideration before you take that decision of buying or selling into the market. Now, for example, you see a pin bar here. So market was coming down, then a pin bar appeared, and then market push back up from that position. As I explained earlier, a pin bar show you that market can go up from that position. And I said the color doesn't really matter. As you can see, this is a red candle bearish candle, but it's a hammer or a pin bar, signifying that buyers step into the market at this position, making a long tail, signifying that the prices are going up from this position. While here you see a hammer, a green hammer candle, prices have been going up. When this appeared, prices begin to fall from that position. For your assignments, just open your candlesticks, and then check all the pin bar that made a reverse in trend or reverse the market. Just check as many as possible, check maybe up to 50, so that you'll be able to get familiar with them, get familiar with the pin bar, get familiar with the bearish and the bullish engulfing bar. They're the two most important candlesticks that I want to explain, that I use in my trading. From here, let's move to the market structure.